Hi everyone and welcome to this new video. We will be talking about the JPMorgan Nasdaq Equity Premium Income ETF. The ticker is JEPQ. Basically, this is a relatively new ETF. It's issued by JPMorgan and it focuses on providing investors with monthly income stream using covered call strategy. So the purpose of the video is to explain a little bit the covered call strategy, its pro and cons, its limits, and talk in particular about this ETF, what's the objective, and what kind of investors would be interested in this type of ETFs. So in terms of funds holding, the manager of JEPQ invests primarily in large cap tech stocks. As the name implied, it's based on the Nasdaq. So what the manager would do will focus on large caps in the Nasdaq. So most probably the Nasdaq 100, and they will use their own selection criteria to pick companies with the highest prospects, the companies that bring the highest adjusted return. What it means is that based on their own analysis, their own opinion, they will look at historical data, maybe some look at some future prospects and determine which stocks will have the highest return for the lowest volatility. Now, the manager on the website of JP Morgan, their objective is to be an alternative to investing in Nasdaq 100. So if you invest in the Nasdaq 100, let's say index ETF, which basically you're just owning the stocks that are part of the Nasdaq 100, most of the investors find it really hard, especially if they are conservative, because the Nasdaq 100 tend to be quite volatile. So by coming up with this new strategy, which is covered call, what they are trying to accomplish is help you invest in tech stocks, but benefit from their volatility by getting an extra income. However, this comes at a limit, which is that you're not benefiting from future capital gains or future growth of stocks. So the objective here is to focus on getting some income, a monthly income, and which they achieve by issuing call options. So they will invest here. In this case, they are not going blindly going to the Nasdaq 100. They do some selection, and they will pick the stocks that they like in terms of return and low volatility. And from there, they will start issuing call options on those stocks on a monthly basis, thus generating income and increasing that the distribution, it's quite successful, because if you look at their dividend yield here at Yahoo Finance, you'll see that it's really a very attractive dividend yield at 15.89%. But this doesn't tell the full story, obviously. This is just the dividend yield. So this is what you'll approximately be getting on a monthly basis. However, the performance is twofold. It's the dividend yield and the price performance. So both will give us what we know as we call total returns. So don't focus only on the dividend yield. Try to understand what they are basically doing. So they're using a covered call strategy. So it's a conservative strategy that will limit highly the potential for capital gains. And so don't expect with this type of fund that the price performance will be great. In fact, usually the price will decline slowly over a period of time, but you will be getting very attractive dividend yield if that's your objective. So quickly, like the positives, you have the attractive dividend yield, since that they are issuing call option. This is from past August, but now the dividend yield is much higher. As we saw, it's like 15%. So this is one plus, is an attractive dividend yield. Lower volatility. Let's say if you invest in Nasdaq 100, obviously you have much more volatility, whereas when you issue call options, you are reducing greatly that volatility. But it's still a volatile investment, though. It's not like something that if you are in the market for 1 to 4 years, you should not be owning this type of fund, because this is a long-term fund, but for income investors. But it's still a long-term fund. So don't invest in this and hope to have a positive total return in 1 year or 2 years. It's really in the long run. And you can improve the performance highly if you reinvest those dividends. That's also a strategy that some people use to compensate for the decline and the lousy price performance that comes with this type of fund. It suits conservative investors and income seekers. So if your primary objective is just to earn that income on a monthly basis, which I don't understand why a young person would follow that strategy, it's better just to stick with with long-term ETFs that invest in stocks directly and then benefit if those stocks rise. You benefit from capital gains, you benefit from their growth potential. I don't see why a young investor will forfeit that for a high dividend yield. Usually you're saving for the future. You're not seeking a passive income if you are still young. So it's really for someone who's retiree or close to retirement, then it would make sense for them to own this type of fund, as long as they are comfortable with the premise here and the strategy. So you have high volatility usually increases the premium earned by the fund. What this means is when you invest in a covered call ETF, you will notice that the ones that offer really crazy dividend yields usually invest in tech stocks. Why? That's because options that they issue provides you more income as long as there is high volatility. So where do you find volatility in the markets? It's in the tech industry, in gold companies, in mining. So that's where the areas where you have the highest volatility. And of course, you will, if you issue options in that kind of market, you can expect higher premium if the manager predicts correctly the market. So it's important to look at managers who have experience, and also to keep in mind that that dividend yield is not set in stone. As you can see, past August, it was just 10%. Now it's 15%. It could drop again if the volatility goes down. So it's not something that's, it's not the same as when you own a regular dividend ETF that just takes the dividend from the companies that make the portfolio and pays that to you. That's more safe because those stocks and those companies pay generally 4-3% dividend yield, and you will be paid. But for this type of fund, obviously the Nasdaq 100, finding a company that pays dividend in the Nasdaq 100 is really rare. Like tech companies don't pay dividends. Usually they're focused on growth. So all your 15 or 14% dividend yield is basically just options, and it's coming from the volatility in the market. If that volatility goes down, then you will end up with lower dividend yield, and you're relying pretty much a lot on the competence of the manager. So you have to look at the manager, how long he's been there, if the fund is new, old, what was the past performance of that manager, were they able to pay dividend every month, did they miss a dividend in a specific period? So all these criteria, you have to pay a lot of attention to those criteria when you are investing in a covered call ETF. One of the other positive is that it saves you time and effort when, let's say, if you want to apply that covered call strategy yourself. That's a quick way to have that strategy is just by buying this ETF instead of implementing it yourself. It's also a relatively low fees. It's only 0.35%, which is on average. That's the usually this kind of ETF charge usually this type of fees. So that's for the positive. The negative, as I mentioned, there is the poor performance. You are essentially giving up on the upside potential of the Nasdaq 100. So if you imagine two people, one invested in the Nasdaq 100, the other one invested in a covered call ETF that tracks the Nasdaq 100, like JEPQ, you can pretty much be certain 100%, like 15 years from now, the one that invested in Nasdaq 100 will definitely have highest total return, due to the ability to benefit from the growth potential of these amazing stocks that make up the Nasdaq 100, whereas the other person who invested in a covered call will get their income that was their primary objective, that monthly income that allows them obviously to pay bills and stuff. So it's just a way for them to organize their life. They want to have that income on a monthly basis. They're not looking for no income for now and just waiting for that potential return. So you're therefore forfeiting the potential return for that immediate income. So the strategy of covered call becomes ineffective in an unpredictable market. Obviously, if the manager is seasoned manager, they will be able to read correctly the market. But of course, they can make also mistakes. So this is what, and also adds to the volatility of the dividend yield. So don't expect the dividend yield to stay the same. JEPQ is dominated by tech firms, so it's far from being like if you own just that ETF. Keep that in mind. You're just having an exposure to technology companies. So you want ETFs that also probably own other ETFs or stocks that are in other industries, not just be on one industry. So in essence, covered call ETFs, there is a lot of covered call ETFs right now offered by other companies other than JPMorgan, and some of them have been for quite some time. So you can look at their historical performance. You can visit like Yahoo Finance, and you can look at the total return for instance, just to have an idea of what kind of return to expect. And this is again the total return, so it's the price performance and the dividend, not just the dividend. So which I advise you not just to look at the dividend yield. So for JEPQ, like year to date, it was 5.30%. On a 1 month, it's 5.21, and 3 months, it was 4.13. And it's a recent fund, so we don't have the historical returns yet. So we'll have to wait till see the overall performance. And the dividend yield, as I mentioned, is 15.89%. The covered call ETFs, they are popular because of the high dividend yield and the low volatility. But again, before you pick the one that suits you better, ask yourself if you are the person for this type of investment. Are you in a stage of your life where you need necessarily that monthly income? And does the fund has ever missed a dividend payment? That's a crucial question. And does the manager have the experience? And also, like, what kind of dividend yield to expect, and what type of stocks or industry that this covered call ETF invests in. So that was a quick review of this fund, JEPQ. Thank you for watching.